Welcome back to another video, guys. I'm Patrick Zimmerman. Today we are going to be talking about the third step in Dave Ramsey's Total Money Makeover, the full-size emergency fund. We've already covered steps 1 and 2, which is the $1,000 emergency fund and then the debt snowball. You can check those out in a video I did last week. I'll throw it up on the screen here. And then today we are also going to go over 3 different types of accounts: money market accounts, high yield savings accounts, which we touched a little bit on last week. If you'd like to check that video out, I'll throw it up on the screen as well. There are 3 suggested accounts to open up in there, so I would definitely recommend you look into those if you don't have your $1,000 fund set up yet. Don't forget to like, subscribe, and comment down below. At the end of the video, I will also be suggesting 3 different money market accounts that I recommend you use for your full-sized emergency fund.
Skies are clearing up.
So here are the rules for the full-sized emergency fund. You want it to cover 3 to 6 months of your expenses. For most people, this is generally somewhere between $5,000 and $25,000. You're going to be deciding between whether you need to secure 3 months of expenses or 6 months of expenses, depending on how much risk you're taking with your money currently. If you have 3 cars, it might be a better idea to go for 6 months of expenses rather than 3 months. Because if 2 of your cars break down at one time, that's going to be double the cost of what you would be paying to fix just 1 car. I believe it to be more advantageous to set aside 6 months of expenses in case something like losing your job happens. Then you don't have to go jump into a new job which you may not like right away. Instead, you can take your time, look for a place of business that meets your criteria, somewhere you'd like to work, and then in the long run, that situation may make you a lot happier than a job which you just had to throw yourself into to increase your income. Just like the $1,000 emergency fund, this should only be accessed for emergencies as well, and we also want to do our best to keep it liquid. This means easily accessible. You won't have to pay a fee whenever you try to withdraw or deposit extra money. So let's talk a little bit about high yield savings. I did a video on this. Let's talk a little bit about high yield savings. Last week's video had 3 suggested accounts. I believe at that time the Digital Federal Credit Union, or DCU, high yield savings account had a 6.17% APY. This is significantly higher than the accounts we're talking about today, but that percentage rate was capped at $1,000. There's oftentimes for high yield savings accounts, there's no minimum balance. They're only subject to 6 withdrawals a month, and they do not have paper checks or debit cards associated with them. This isn't a real issue because of online banking now. It's very easy to transfer your money between your accounts. Oftentimes banks will have fees for wire transfers, but automated clearinghouse or ACH transfers are generally free as long as you're willing to wait 2 to 5 business days for them to go through. The next type of account we're talking about today is the money market account. This is often described as a mix between a checkings and savings account. In my opinion, this is the best place to keep your full-sized emergency fund. They often offer higher interest rates than traditional savings accounts. Likewise, they only allow 6 withdrawals a month. Now, where they start to change a little bit from the high-yield savings accounts, which we have previously talked about, is that there is generally a minimum balance. And also, depending on how much money you're holding in the account at said time, they have tiered rates. We'll look further into that with some examples later on in the video, but essentially, if you have $5,000 in your account, you could be making 1% APY, and if you have $20,000 in your account, you could be making 1.5%. So just like that. Money market accounts are not required to have paper checks or debit cards available or associated with them. But in certain situations, you can get an account with paper checks or a debit card. I think this is nicer in the money market account because if you have $25,000 in a money market account and you lose your job, then you don't necessarily have to keep transferring out money from your savings or your account to your checkings account. Instead, you can get a debit card or a checkbook associated with the account and just make your payments straight from the account. And just make your payments straight from there. If you do have a debit card associated with the account, you're not allowed to have more than 6 transactions a month, just like the high yield savings. If you transfer money from your money market to your checking account twice a month, then you cannot exceed 4 debit card transactions in that same month. You can only move your money out 6 times. Also, with the money market accounts, it's important to note that we are not talking about money market funds. This is somewhere where you would invest your money similar to a closed-end fund. It's not solely subject to growth due to interest, but the price fluctuates more like a stock. You should not keep your emergency fund in a money market fund because if you put $20,000 in there and the price drops, then you're not going to be able to withdraw that full $20,000 which you placed in the account. All right, the last type of account we are talking about today before we jump into the money market examples is certificate of deposit. These are often referred to as CDs. They generally offer slightly greater interest rates than both the high yield savings or the money market accounts. Similarly, they do have a minimum balance with tiered rates. The difference here is that you cannot withdraw any of that money or deposit more money into said account without a fee being charged. So alongside your CD when you choose it will be a term length. So a 1-year CD, a 2-year CD, a 3-year CD. If you go with the 1-year certificate of deposit, then whichever principal was placed in the account at the time of open cannot be taken out, nor can you add more money into the account without a fee being charged. For that reason, CDs make little to no sense to keep your emergency fund in. If something happens which you weren't expecting and you need to access that money in your certificate of deposit, the bank or credit union will charge you a fee if you try to take out that money early. Let's jump into the reviews here. All right, the first review we are talking about is CFG Bank. You can see right here they're advertising a 0.9% APY 18-month term certificate of deposit. Obviously, we already discussed why this is not a good place for an emergency fund. We're going to be looking at the 1.10% APY high yield money market account. The money market account has a minimum deposit to open of $1,000. And that $1,000 is also the minimum balance which can be kept in the account. CFG's money market account is a good example of the tiered system because as you can see here, this is the same account type. And if you have below $25,000 in the account, you'll be making a 1% APY. Above $25,000 in the account is going to qualify you for the 1.10% which they are advertising. It's also important to note with these accounts that you are not capped on deposits per month, but there's also no check writing, nor can you get a debit card with the account. The next money market account we're talking about is from Total Direct Bank. They offer a 1.05% APY with a $2,500 minimum deposit. If you're not aiming for that $25,000 threshold advertised at CFG, which allows you to earn the 1.10% APY, then the Total Direct Bank account may be better as it's giving you an extra 0.05% annually. This account also does not allow debit or credit cards or checks. Something else to note here is that the maximum amount allowed per client is $500,000, and it is FDIC insured up to the maximum allowable amount. This is interesting because generally a single person's only insured up to $250,000 per account by the FDIC. Like I said, this is interesting, but you should never really have more than $250,000 in a money market account regardless, so something cool but not very important. And the last money market account which we will be looking at today is from Axos Bank. They offer a 0.9% APY, but I also chose to feature this account because they allow check writing privileges as well as debit card transactions, which is something that the former two did not. Additionally, they have a $1,000 minimum balance to open an account, but after the account is open, there's no monthly minimum balance requirement. I really like the Axos Bank account as well as the Total Direct Bank account. I think the CFG Bank would be advantageous if you're planning on exceeding that $25,000 limit, which will bump you up from 1% APY to 1.10% APY. But as we talked about earlier when we went over the rules of the full-sized emergency fund, you may not need more than $25,000 in there. Maybe throw in 26,000 just to get that 1.10% threshold, but anything more than that should be going into investments or something else, which we'll be talking about next week, I'm sure. If you were someone who needs to dip into their emergency account a little bit more than normal, the Axos Bank account may be more beneficial because they offer those checks alongside a debit card. If you don't take issue with ACH transfers between your money market account and your checking account, then the Total Direct Bank is probably your best. The 1.05% APY with only a $2,500 minimum. Thanks for tuning into another video, guys. If you have any questions, leave them down below. Don't forget to like and subscribe, and I hope to see you all tomorrow.
It's black and white.